Hello everybody, it's me, the Boss Hog. Going to be having a look at my portfolio as of the week ending the 9th of September. Also got a new mic this week, so thank you very much for the recommendation. And without further ado, let's go on. Alright, so slightly different to normal this week, just because there isn't a huge amount happening. But in terms of update, I mean, it was a pretty good week, honestly. I've been benefiting quite a lot over the last few weeks with favourable foreign exchange movements. Actually, this week it kind of reversed, but there was enough good movement that it wasn't really much of a problem. You'll also see in a second that my largest holding had a particularly good week following, not necessarily a business update, but like one of its main product. It was updating on numbers, and they were really positive, I would say. So broadly speaking, direction of travel was definitely good this week. I didn't add any capital. We're back on track basically for that. The last couple of months have been quite expensive for my wife and I for various reasons. My wife does now have a new job, but as part of that, she was buying things, and there's been a few other costs as well. So I do expect us to fall slightly behind in terms of what we're aiming to invest, which is £800 a week. And also we got quite a high electricity bill, which I guess is quite a common occurrence for many Europeans at the moment. So I do expect us to fall a couple of weeks behind before we're able to kind of catch back up between now and Christmas. So that's the plan there. Just one dividend this week. I did mention previously that I expect September to be my best ever month. Just a lot of things coming through. Some of them are toward the end of the month, so it'll be interesting to see if they land. But so far, just Microsoft. And honestly, this was my only dividend and my only buy this week, so I haven't even got much information in terms of my buys. It's just pointless to share it. I just reinvested it back into Microsoft, which I think is a very fine business. Of course, it trades on a hefty multiple, but I think it's absolutely worth it. So I guess instead then of sort of telling you what I've done, which is pretty uneventful, I thought I'd actually share one of my portfolio graphs. So I use Google Documents. I've created my own portfolio tracker. It brings together 3 different investment accounts that I have active between myself and my wife. And what this is really this is my main graph to see how I'm performing. Now, what you might see is like, okay, time weighted. Well, how comes Boss Hog, you're only like up 1%, right? The reason for that is because time weighted assumes a kind of gradual, continuous investment in of $100 or £100 on day one, and then basically what it does is it compares different indexes at the close of each month. So basically that's what each one of these data points are, and it compares me, the S&P 500, and the FTSE 350. So basically, if instead of putting lots of money in at the beginning when maybe the market was a bit expensive, I'd have invested, continuously over the last sort of nearly 2 years now, that actually would have been better for me. There's quite a lot of data that suggests the difference is quite close between sort of putting it all in at the beginning and spreading it out. I had the money available, I was keen to get started, so I don't really regret it, but it's also at the same time quite annoying to see it. Pleasingly though, after sort of my relative disaster of investing in 10% of my portfolio into Russian mining companies, which is the big drop there, I have been catching up the S&P, and now I'm gradually starting to make inroads into the FTSE 350 as well. Interestingly, for the FTSE 350, it's held up comparatively well, because even though it's light on tech stocks, which is one of the reasons why it was underperforming previously, it's very heavy on commodities and things like insurance and other high-yielding stocks. So it's actually been performing quite well year to date. It's kind of one of the best performing major indexes. It's down just a couple of percent. So that's worth noting. So it's kind of interesting the way the FTSE 350 has kind of been, steady Eddie, kind of tortoise. Maybe it wins the race, but obviously this is just across less than 2 years, so it's not a huge data set. For me, I've given myself 3 years to see how I perform. So far, I'm relatively happy, and I think actually I'm most pleased with how I responded to some significant setbacks. I'm very red on a couple of stocks and extremely red because of my Russian miners, which are down sort of 80 to 85% for, I think, quite obvious reasons. But since then, for the last sort of 6 months, I've been outperforming both indexes and basically gradually catching up. So that's how I look at it, basically, like how I'm doing. Thought it'd be interesting to share. And yeah, I'm happy to share that more often if it's of interest, maybe once a month, which is when sort of it will when I crystallize it, basically. So the final numbers here can change within the month, but the historic data shouldn't change. It's sort of captured at month end for how that month is done. So I just wanted to share that. I thought it might be interesting. Like I say, no real buys or sells this week other than my Microsoft reinvestment. So instead, let's have a look at the breakdown of my portfolio and how that's been performing. All right, so we're going to talk about everything that's highlighted green here, but standard stuff. If anyone's interested in stuff that's not highlighted green, comments, questions, etc., down below, I do my best to respond to them. And I think so far I've got every update that people have asked me. So first of all, I want to talk about GAMA. This is my largest holding. I work in telecoms. I think I have a really good understanding of GAMA. I think its efficiency measures have historically justified a very high multiple. Now, in fairness, about a year ago, it put out numbers that were basically in line with expectations, and for whatever reason, the market just had a bit of a meltdown. So it's actually lost about half of its value since its all-time high, more than half of its value. I think right now this is a really screaming buy. Depending on what multiple and what kind of assumptions you make, I think it's somewhere between 19 and 24 pound a share. May look ridiculous at 12 pounds. Typical investor put this about 17 to 22, so I guess it's worth highlighting that I'm a little bit more bullish than average, but I think it's for a good reason, and again, I think I have a very good understanding of the industry and indeed GAMA. So they didn't actually have really a business update, but there was sort of a what's called unified comms. Sometimes it's called fixed mobile convergence. It's kind of still up there in terms of what it's called, but basically it's where GAMA's been very successful in kind of they call them seats, but basically like subscriptions of people who are coming onto their hosted solutions, and they were really positive. And I think the market just really responded to it. I couldn't find any other update for GAMA. That was the real standout for me. And yeah, I think it's a good news solution about really what is the main drive of GAMA, which is the fact it's built an incredibly good scalable solution that should meet the technological challenges of the next sort of 10 to 30 years extremely well, and it doesn't have really any of the legacy stuff that your larger telcos typically have. So we'll see how that goes anyway. There is some interesting rumblings at the moment from the European Union, specifically in Europe, about the fact that heavy data users like Google, for example, and YouTube and maybe Netflix, they should be paying for telcos' network infrastructure. That would be very interesting to see the way that gets discussed. We'll see how that shapes out. If it does look really interesting, or people are interested in sort of telco experience and want me to delve into that in a bit more detail, absolutely happy to do that as well. And likewise, if somebody wants me to have a look at Vodafone or I don't know, TELUS or somebody, I'm more than happy to do that as well if that's something that would add value to people. But like I say, there's a reason why GAMA is my largest holding. It's an extremely good dividend growth stock for the future, and I really believe in it very strongly. So pleased to see a very good week. Hollywood Bowl here is actually a bit of a conviction for me as well. I would note, just like many consumer discretionary, it's been beaten up, but its competitors, who I think are worse than it, produced good numbers. And I'm not really sure why Hollywood Bowl themselves have been beaten down. Even things like the fact that they're replacing their energy demands with solar panels, I think should sort of insulate them. They've also got a hedging as well. And generally, I think their international expansion into Canada is smart. And I think it's a very well-run, small little business. It's still a penny stock. It's like less than $500 million market cap, so it's definitely on the small end. And I get that bowling is ultimately a leisure activity, but for me, it offers really good family entertainment for way less than something like a cinema costs. And also, I'm very bearish compared to cinemas, because I think cinemas can more or less replace with a home experience, and I think they're expensive, so I'm not touching cinemas. Whereas bowling, I think it's a lot harder to replace that experience at home, and like I say, ultimately, I think people still do want some fun, and I think bowling is a good way of spending a couple of hours, and Hollywood Bowl built a very good digital, actually, business model that, again, I think will put them in good space. If I was able to buy individual shares at the moment, and I can't because my wife works in private equity, but I would absolutely say that Hollywood Bowl would probably be one of my favorite UK stocks to be buying at the moment. I think there's a real risk reward here that is clear. I expect them to be profitable for this year, having really struggled to make a profit over the last couple of years. And I think this year they'll return to a decent profit, and we'll go from there. MPW, I sort of talk about this a little bit more in Discord, part of Paul Briscoe's Discord. And for me, I mean, I'm really confident on MPW. Again, I'm a little bit red at the moment, down about 8%, or about neutral, I think, once you include my dividends. But again, I think this is a niche REIT which isn't well understood. It reminds me in many ways of like Vici just a few months ago, before kind of the market appreciated that it was worth investing in a niche REIT. I think the same is very true for MPW as well, where basically, because it only does hospitals, this isn't general healthcare, it's specifically hospitals. These are sort of marquee, very necessary buildings that aren't easy to replace, have high barriers to entry, and even when the worst does happen and one of their tenants goes bankrupt, they're able to realize sales either via selling the actual building itself, which they have rights to, or finding new tenants, which they've been able to do in the past. So even though some of the bearish arguments about sort of having top heavy, maybe financially unsound tenants, first of all, I think it's not really that true anyway. But even if the worst did happen, then I think MPW would be absolutely fine. And I think, again, MPW is just very poorly misunderstood. It's difficult to compare to the healthcare REITs in general, but even if you did, it stacks up pretty well in terms of its value and its comparisons to the wider, especially elderly residential care homes. I think it's just, actually, I'm not really very bullish on that specific area of healthcare. But MPW I really like as a sort of niche play into hospitals. So again, I sort of re-listened to their quarterly update a few weeks ago, and I just thought it was worth mentioning. CRM I haven't actually spoken about, but I just wanted to give a quick update. Again, I've talked about this in Discord, but ultimately here I thought CRM's results were really solid. Yeah, maybe historically the shares have been a bit expensive, and you've had a lot of dilution in terms of share compensation for staff, as well as to fund growth. But actually, I think CRM have actually acquired relatively smartly. Maybe Slack is a bit of an iffy one, but things like Tableau, I think are excellent acquisitions. Basically, you're plugging in a visualization tool on top of your data environment, which CRM is also obviously the application on top of that data environment. So overall, I just think that CRM has bought well, has got a very well-rounded proposition, which is going to appeal to sort of sales directors. And ultimately, in my experience, those are the people who are driving investments, because it's easier to have a business case when you talk to your CFO. So I think there's a reason why Salesforce is still a little bit of an expensive stock, although I think it's come down a lot. And for me, most pleasingly was actually a fairly sizable buyback. It wasn't that long ago before the likes of Apple were actually diluting shareholders as well, and now they're like a buyback juggernaut, right? Maybe it's a little bit too ambitious to compare CRM to Apple just yet. But for me, I think the trends are definitely there. I expect them to start, now that they've sort of built this infrastructure, I think that it's a very good well-built business that will appeal and will continue to grow ultimately. The only way I see further acquisitions for CRM is to maybe buy an ERP, so like basically a financial system, but it isn't strictly necessary. There are very large competitors in that space, including Microsoft, although I could say the same about Microsoft Dynamics in CRM. But ultimately, I think now it's a very good sort of back office system. Yeah, you could buy an ERP system, but I don't think it's necessary. Especially because CRM sort of plugs into existing infrastructure very easily, one of the main pluses for it, in my opinion, as well. So I was actually incredibly optimistic about CRM. I'm down, but only very slightly on CRM. I previously did average down into it. And yeah, I'm very confident in holding this for the medium to long term. Next is, so this is my best performing stock historically. I'm up many thousands on Huntsman Corporation, the better part of about 5K, I think, so pretty significant. I went on their last earnings call, and to be honest, I probably do need to do a deep dive and share it with you, but like ultimately I think the business is still mostly doing okay. Yeah, it's got like one division that they're considering, they're basically listening to offers for, although it's by far their smallest division. But again, if they do sell it, they're not like under any pressure to sell it. It's still profitable. It just hasn't got, the 20% margins that the rest of the business have. So it's not like a pressure sell or anything. Profitable business, yeah, absolutely. You've got FX headwinds at the moment, as well as China headwinds with the kind of continuous lockdowns, and generally there's sort of some geopolitical risk there. But I'd also point out that this is like an extremely forward-looking chemical company. They have sort of several processes and products that are difficult to replicate, and basically they're the only provider in the US mainland. So they also have some geopolitical advantages there as well. And again, overall, I think this is just an incredibly cheap company. You do have to, if you were to look into these numbers, and again, this is maybe where I need to do a deep dive, they did win an arbitration case with a competitor. So some of the numbers at the moment, you really have to delve in because they look ridiculously good, where they're still receiving income as part of that deferred settlement over time. But still, if you look at the underlying business, I still think it's good. Once you strip out all of the noise, you end up with an incredibly low multiple for a business which has already, in my opinion, gone under a difficult transformation, right? This was a business that historically underperformed, but over the last sort of 5 years, they've really sort of got rid of a lot of low margin stuff. and moved into sort of what do they call it, quality instead of quantity, right? So ultimately that's the direction that they want to be going, and ultimately I think they've already succeeded in that. So even though there's some headwinds and some weird one-off lines that you have to get your head around, I think it's really good value at the moment in the 27s. I got into this at like $24 last year and sold in the mid 30s, and now I'm back in sort of an average around 30. And again, for me, it's a buy. It might be one of my favorite US companies to buy at the moment. Although I think there's a few of them like Huntsman. I'd probably be interested in Micron, MPW as well. I think all would be an opportunity for me to add at current levels if I was still buying individual shares. So that's worth mentioning. But let's move away from individual shares to talk about a REIT, but an ETF REIT. So this is TRET, and we're going to discuss that in a little bit more detail now. So let's do it. All right, so this is a little bit hard to get your head around because its market value is in euros and that's how it reports, but the share price is in dollars, but the ticker is in the London Stock Exchange. So just get your head around that a little bit. For me personally, just to explain why I buy some ETFs that trade in dollars, for me, I basically have my portfolio split between dollars and pounds. I've gradually gone down from being about 60% US to being more 50-50, which is my long-term aim. The reason why I was a bit heavy on the US is because I expected to benefit from FX movements, which is kind of true. I wish I'd gone even heavier actually. But currently I'm sitting about 53% US. And again, for me, it's a useful currency hedge, especially like, in the long term, let's say the pound continues to underperform against the dollar or vice versa. It just means that when things like dividend come in, or potentially I can put it into different currencies and just move it around how I think is best. So it gives me just an additional layer of flexibility in how I manage my portfolio ultimately. So in terms of this ETF specifically, so it has 99 holdings. I would say it's on the lower end of some of the ETFs that I've invested in. Most of them have sort of north of 100, but not massively on the lower end. And also I would say it's not a particularly heavy top end in terms of the top 20. Like other ETFs I've looked at have been sort of 65 to 70% and then incredibly long tails. Actually here, like their top 20 is only 57%, although I would point out that their top two are pretty significant. So you got Prologis here and Public Storage. So Prologis is partly large because they had an acquisition, and so basically two of them got put together historically. But still, interestingly from my perspective, the average PE here is on the more expensive side. And the average yield doesn't look that great, but I'd point out a couple of things here. So first of all, this isn't including the September dividend that's about to be paid. If you include that and instead do a rolling year from that, it significantly increases this yield, puts it about 3.2%. The main reason for that is because some of the things like office REITs and shopping mall REITs that have underperformed over the last couple of years are basically starting to get back up and running. And so there's a possibility here that the yield from this will increase. And also, unlike some of the ETFs that we've covered previously, this this dividend is actually distributed. So it will be paid, for about 13 shares, and I think I'm getting about 72 cents for those shares. So not a huge dividend, relatively speaking, but actually, about 10 quid. Will just be reinvested, I think, back into this fund. And yeah, it's on the small to medium side, I suppose, size in terms of ETFs we've been looking at. Now, I would also point out as well, first of all, I think it's a bit poor that VanEck don't actually do like an industry breakdown for the REITs. It would be really helpful if, you could see like 20% in storage and 20% in retail and so on. That's not the case. What I can say is, having sort of had a little read through the top 20 and had an eyeball the long list of 100, is that they're quite light in a few areas. So they are quite light on data center REITs, I would say specifically, which is a bit strange to me actually. And they're heavy on things like retail and residential REITs. You'll also see a couple of like fairly large positions in healthcare REITs here, like Welltower being an example. And yeah, so I just find that all a little bit unusual. For me, it's not really a problem because, like I say, I don't consider MPW really a typical healthcare REIT. And likewise, I already have DLR as a single standalone position. So for me, it's not too much of a problem because it's fairly complementary, but just something to bear in mind. I would also say as well that they're relatively light in certain REITs that I think Europeans will be more used to seeing. Like I was kind of surprised to see B-Box which is way down on the list, you know, of like 0.4% holding. Likewise, the European equivalent as well is even smaller. And although there are sort of, you know, like there's a German company in the top 20 here, Vonovia, and then you've got the like of Link as well, which is Hong Kong based. So you do have some interesting geographic exposure that maybe you're not particularly familiar with. But yeah, just be a bit mindful about the fact that this is not necessarily entirely diversified by REIT type. So if you're looking to add to this, maybe you'd, like, I don't think there's anything wrong with the REIT, with the ETF, but I think you want to plug in some gaps and be mindful about the exposures that you do have here. So for me, again, like it's fine because not only do I have that other things to fill in the gaps, but actually to me, again, I think a lot of the stuff that's been beating up the shares over the last probably couple of years is coming to an end. So again, if we jump over to the performance here, you can see that their 10-year performance is perfectly fine, right? Nothing stellar in fairness. Like I don't necessarily think REITs are meant to be stellar growth. This is sort of one of my more conservative holdings. So seeing 8.5% as an average here is not a problem. But again, you have to be mindful about how it's performed over the last sort of few years. And really, again, when you have heavy exposure to like retail, office, shopping malls. I mean, look how high Simon Property Group is here, right? I know it's like the most diversified of the shopping mall group. It's better than sort of Macerich as an example, a share I've owned in the past before. But still, I mean, this is a very large holding, and obviously that's going to struggle, as well as the other holdings here as well. So again, just be mindful of that. I am expecting them to perform a little bit better over the next few years. Again, I expect the dividend to increase. So if you're an income-minded investor or you want that dividend being paid out instead of being reinvested in the ETF automatically, then it may well appeal. But I think I just want to kind of like, whereas when I've covered other ETFs, I've been like, yeah, to me, that's a clear buy, right? Because it's very well diversified. The one we covered last week when we were looking at a commodity ETF, I felt like was a great, it was difficult to pick holes in it. Whereas this I actually think is quite easy to pick holes in. So it doesn't mean it's not a good investment. It could be a good investment. But again, just be mindful of what you're getting yourself into. Management fees here are fine. As I've touched on before, I don't want to pay more than 0.5%. So paying 0.25 is absolutely fine. I have no issues with it at all. Trading at its net asset value, again, as expected, really. And this is a 4-star Morningstar review. It's worth pointing out that over again the last couple of years it's put it at 3 stars, but its overall remains 4-star just because of its long term. So again, you might want to consider that, maybe not, but just there. Also as well, although the VanEck itself classes this as a large ETF, Morningstar has different classifications. It has an extra layer between like huge and large. And actually a lot of these companies are classed as medium. So what happens is if you look at the like Morningstar grid, they're very high in the medium, so they're like just below large, and then they're blended, between in terms of like growth and income. So again, for me, I think it does have some elements of it where it's well blended. I think the geographic distribution is fine. Doesn't really excite me or worry me in any way. I have very little exposure actually to China, especially because I'm so commodity light at the moment. So I suppose that's a nice thing as well. And most of China, I think actually all China, I can't remember seeing a China share, is in Hong Kong specifically. But again, that's just something to be mindful of if you're concerned about the Chinese real estate market at the moment. Worth having a look at if that's a big concern for you as well. I definitely do have concerns about the Chinese real estate market at the moment, but the holdings in this aren't particularly exposed to that side of it. And it's relatively small part anyway. So the rest of it, I'm actually fine to have holdings in Germany. I don't have a huge holding in Germany, and Japan and Australia here. These are countries that I am interested in getting more into, but I don't have an ETF in. So for me, again, it's great. Whereas, for example, I do have a holding in Canada, so I'm not requiring particularly strong exposure to Canada. So again, for me, I like this ETF because it's filling in a lot of gaps, and I have a very complementary portfolio overall, is how I look at this. But I would say everything I've said should be considered, and you should definitely do your own research to see if this is going to be complementary for you and whether it works in your portfolio as well. So just wanted to go into that. Just the one deep dive this week, if you can call it that. I work in a financial department, so my month end / start is extremely busy. So I didn't have a huge amount of time, but we will be covering a few more next week. And we'll go from there, I suppose. So just a relatively short video by my standards. Any questions, comments, etc., please below. Oh, and I appreciate feedback on the mic as well. Hopefully it's a bit clearer. Certainly feels better when I was testing it. Otherwise, thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.